Okay, good morning, friends. Welcome to the weekly Saturday knowledge sharing webinar organized by Mehta and Mehta. And today's topic of webinar is uh, an insight into the issue and redemption of preference shares, including accounting and taxation aspect. And today, the presenter is our senior manager, Ms. Suchita Mahalik from Mehta and Mehta. Ms. Suchita is a member of the ICSI and has completed BCom and pursuing LLB. She is working with Mehta and Mehta as a manager since 2019 and comes with 6+ experience in corporate secretarial compliance, FEMA compliance, DD, and of private, unlisted, and listed company. We have with us our panelist, today's panelist, Mr. Rahul Roy. Rahul is a compliance and legal professional with over 13 years of experience in FEMA and legal compliance. His diverse journey spans across corporate law advisory, legal tech projects, compliance management, process optimization, and venture capital investment portfolio management. He has been involved in multiple key transactions with esteemed venture capitalists within the dynamic venture capital space and startup economic ecosystem. He is member of Institute of Company Secretaries of India. Mr. Rahul, welcome to Mehta and Mehta.
Thank you so much, ma'am.
Thank you for
It's
your
a pleasure.
time. And surely it's a venture capital and FEMA and corporate and legal. It's a really diverse experience and interesting life journey, professional life journey. Welcome to Mehta and Mehta. Thank you for your time.
Welcome. It's my pleasure.
Thank you. Friends, along with us today, as usual, our own moderator, Mr. Balakrishnan is there. Mr. Bala, we call him. He is a CS with almost 4 decades of experience in secretarial compliance and worked with Foseco India and is a regular speaker at ICICI CCGRT and contributes various magazines continuously since years and years. He is a record breaker in writing articles, especially any decided cases, you can ask him in Companies Act. He is a kind of a Bible for that. Welcome, Mr. Bala. Friends, as today's topic is preference shares, Mr. Sudhakar Sarvatullah is not there because he's on a personal his commitment and he has to attend Secretary Standard Board meeting today, so he's not there today. Friends, we thank all our panelists for being here. Thanks a lot. Today's topic being preference shares, it's always an interesting topic to me from the study days. Because if you see, it has a combination, it called shares, but you have to return back. It carry fixed interest rate, which is the features of borrowing, loan, or as such. If we see, it is called shares. So we wonder how it is shares. And that's why it is a confusing security, but very interesting security can be utilized by a corporate in a very interesting way because it has a liberty of conversion into different security. That's also interesting. Again, you have that option of conversion either with the company or with the investor. In Companies Act, officially, not a single security has such a kind of options which you can combine. And further, Companies Act make it clear it's a share. When you can count share capital, you can use it. So it's make sure that your free reserves, your temporary borrowing, your interest rate, right? You decide the interest in advance, various options. Again, or it can be sharing because there are different kind of preference shares. So again, add features to that. So it's a very interesting instrument can be utilized by corporate. And as and when preference shares I see in the balance sheet, I always like to understand from promoter why you issued this. What is the, because each time you will understand how these securities can be used for raising the funds with the different other your motive can be achieved, objectives can be achieved. And with us today, Mr. Rahul is there with the great experience in venture capital dealing with different investors. So he will share his knowledge and experience and practical aspect. Welcome, Rahul. We'll look at your sharing the experience. And I'll request Mr. Rahul to say a few words on the topic, then Mr. Bala for a few minutes to say a few words, and then Suchita, you can start the presentation. Over to Mr. Rahul, please.
Thank you so much, ma'am. And firstly, it's a pleasure coming on a Saturday and sharing the knowledge with so many. And I can see like so many participations. It's actually great to see. And always a pleasure to be part of such sessions where, and what I believe is that it's not just what we learn, but it's also what we share, what we learn. So that's the most important part of us being a professional, that is not just learning, but it's also sharing the knowledge that we learn on our way and during our career. So as ma'am rightly said that preference shares is a unique breed of instrument which has the characteristics of both equity and debt on the other side. And interestingly, what we see is since we are in an era of venture capital funding, fundraisers, startup ecosystem is the buzzword, especially from the city where I come from, Bangalore. So we call it the hub of startups. So funding is something which is talked about very frequently. And if you ask any investor, the preferred mode of their investment would be preference shares. And why preference shares? So that's the unique characteristics of preference shares, the preferred dividend rate, the way they can protect their dilution in subsequent funding rounds if there is a down round. So we will discuss all of these as we go ahead with this session, and Sucheta kind of takes us through the different slides. So we will keep on pitching in terms of how practically each of the characteristics of preference shares kinds of play out in the practical world, and why it's the preferred mode of instrument which is issued to all investors. So a lovely topic, and I'm hoping it would be a very engaging one, and look forward to some interesting questions. And really excited for this session. I would pass it over to Professor Sir to take it forward from here.
Thank you, Mr. Rahul.
Good morning to all of you. As you know, I have always a great pleasure in meeting you all and participating in this session. Because every time we meet, we keep learning. As Rahul puts it appropriately, it is not only possessing the knowledge, it is also sharing the knowledge with others. That is the whole purpose of this particular section. Dipti and Rahul, they spoke about the redemption of the preference share. The question comes whether when we talk about the preference share, whether it is in the nature of the equity or in the nature of the loan, what is it? That is the first and most question. And if we see recently the index, when it has come, index very categorically said this preference share is nothing but a long-term borrowing. In fact, the presentation, if you look at any of the balance sheet which is prepared index-based accounting, you will see these preference share are actually shown as a long-term borrowing. Very number one. Number two, since shares carry the fixed dividend rate, which is to be payable. So what happens? It is already a commitment. Like when we take a loan, we pay the committed interest. Similarly, here also, the committed dividend is actually payable. When the committed dividend is payable, dividend actually is being a finance cost in the index. It goes directly to the what you call P&L account debit. That is what it happens here. It is not below the line, appropriation or something other. It's not. It is directly going charged to the profit and loss account. But however, when it's come to the secretarial functions, since it is a dividend, unless the shareholder declare this dividend, this cannot be paid. That is another thing. So these are all lot of nitty-gritties which are involved when it is coming to the preference share. And in fact, we can look at the preference share, which is having a different characteristics. Somewhere it gets the characteristics of the equity, somewhere it gets the characteristics of the loan. All those combinations are there. And again, when we go along, different kinds of there. In fact, there is a preference share which is there, which can be redeemed. Again, redemption. It is at your choice. As Dipti puts it very categorically, company can redeem at any point of time. Investor can decide, or agreed terms can be done. Anything can be done in this. You have a lot of flexibility in this. And again, there are various combinations. If you don't want to convert it, it remains as a preference share. You repay it at the appropriate time, maturity time, or if you are unable to pay, you can bring out another issue of the capital and you can pay it off. And not only that, you can convert partly, optionally convertible, partly convertible, compulsorily convertible. All these set of the things are there as it's a very interesting topic with multiple options which are available to the company. Because promoters, without diluting their interest in the equity share, they can go for this sort of the instrument. That is what it is. As Rahul puts it very clearly, the venture capitalist preference mode of financing is preference share. I think we will definitely have his personal experiences since he has been handling many such vendor capitalist issues. So we'll have his best advantages of sharing his knowledge. I think with this, I'll ask Suchita to take over with the presentation. Over to Suchita.
Thank you, Mr. Bala. Yeah, Suchi.
Good morning, all of you. Thank you for the panelists for sharing their starting insights on the topic. So without any delay, I'll start. So I'll start with the introduction on preference shares. So preference shares, commonly known as preferred stocks, are the kind of shares that hold certain prior benefits. So preference shares are released to raise capital, which is called as preference share capital. The shareholders are given preferential treatment in respect of payment of dividend. Other than that, they also have preferential treatment in receiving the proceeds that are realized from the sale of company's assets during the course of liquidation of the company, before anything is paid to the equity shareholders. So this is a small introduction. Let us understand the definition of preference shares. So basically, preference shares are those shares which have two preferential rights. First is the right to receive dividend at a given rate before any dividend is paid to the equity shareholders, subject to declaration by the company. So the rate of dividend on preference shares is fixed and it is mentioned on the face of the share certificate. Along with the right to dividend, they get a right to repayment of capital before equity shareholders at the time of liquidation of the company. As the name indicates, the shares have certain preferential rights over the equity shares. It is considered as a hybrid security option as it represents the characteristics of both equity and the debt. So I can say preference shares are the long-term source of finance for the company as they have elements of both equity and debt. Let us now see some of the features of them as equity and debt. So the features of equity as equity are dividend from profit after tax, so that they get dividend like equity shares from profit after tax. Also management discretion over payment. So in case the company is not making profit in any year, the company may choose not to pay dividend to the preference shareholders. When I say no fixed maturity, though the preference shares are to be redeemed within 20 years from its issue, there are compulsory convertible preference shares which has to be converted into equity shares at a certain stage. So it becomes a long-term source of finance for the company. Their features as debt are first is fixed dividend. Like we pay fixed interest on the debentures and loan, we have to pay fixed dividend on the preference shares. They always get a preference over stock. No voting rights. So when I say no voting rights, they have voting rights, however, only on the matters which affect their right. We are going to discuss voting rights in detail in the next coming slides. Further, no share in earnings. They do not get any share in the earnings of the company. Fixed maturity. So the preference shares have to be redeemed within 20 years other than infrastructure projects. So these are their features as equity and debt. So in next slide, let us understand the characteristics of preference shares. So the first is preferential treatment. As we are discussing in earlier slides, they get preferential treatment in dividend and repayment of capital at the time of winding up of the company. Fixed rate of dividend. The preference shareholders get fixed rate of dividend at a decided percentage or at the decided value, I can say. Voting rights, they do not have voting rights on all the matters which are being placed before the company. They only have voting rights on the matters which affect their rights. Also on the winding up of the company, they have voting rights also at the time of reduction in the equity and preference share capitals. Preference for repayment of capital. So at the time of winding up of the company or liquidation, the preference shareholders will get first preference for repayment of capital before the equity shareholders. Redeemability of shares. So these shares have to be redeemed within 20 years and the company cannot issue shares which are irredeemable or for more than 20 years. Nature of capital, it is a part of capital, hence it gets that value as a preference share. It forms a part of capital of the company. Capital appreciation, it is a source of capital appreciation for the company.
If I may just pitch in here for
Yes.
Sure,
thoughts.
please.
Yeah, and thank you so much, Suchita, for kind of taking us through this presentation once again. So if you see, there are like two broad aspects which is covered in this particular slide. One is as an investor, what I get back once I've invested. So if you see, there are characteristics like preferential treatment, fixed rate of dividends, which is way more than if I have simply invested through equity shares. And also typically how such investment transactions, when an investor puts money in the company, are structured, there are different LP stacks, or what we call is that liquidity preferences. So those payouts are structured in a way which is more favorable and can be done only if it's a preference shares in terms of their payout whenever there is a liquidity available in the company. So definitely one of the key reason whenever an investor invests is how easily or what is the preference in terms of I getting the money back from the company after a certain period of time. So getting my money back, the payment is one of the key factors why preferential shares are again kind of chosen in terms of any VC or private equity investment. Another key point here is voting rights. I would just like to share some thoughts here. While the law says that as a preference shareholder, my rights are restricted only to matters which affects any of the rights attached to the preference shares, but it can also be extended if your articles kind of provide for that. So the voting rights can be brought in par with the rights which an equity share holds. And as we know, as per the first principles of law, articles can always make it more binding for the company's bylaws. So how we structure such voting rights in a particularly in an investment transaction is we say investors will have the right to vote on as if converted basis. So that means that the preferential shares would be treated as if they have been converted on that particular day to equity shares, and they would have equal voting rights, which is enjoyed by equity shareholders. So some practical things which I have kind of seen in investment transaction and thought sharing would be kind of a good knowledge for all of us here. Yeah, go ahead, Suchita.
Thank you, Mr. Rao. So it can be said that it is a kind of complete equity, because equity is very important and powerful right of voting rights.
True.
And also pari passu preference shares is having. Again, it carries a fixed interest rate. Again, it has a preference over the means preference for return of capital, and also surety repayment. It's very interesting. It makes it. Yeah. Thanks for input. Thank you.
Yeah, thank you.
And not only that, the law also makes it, if the preference share dividend is not paid consecutively for a period of 2 years, in the third year, they actually getting the voting right, that of the equity shareholder. That is also actually provided in order to, safeguard their interest of receiving the fixed dividend. That is also there in the law. Yeah.
Right. Yeah. Yeah.
Yeah. So I'll continue.
Yeah.
So let us discuss some of the types of preference shares that a company can issue. So first is cumulative preference shares. So preference dividend is payable if the company earns adequate profit. However, in case of cumulative preference shares, they carry additional features which allow the preference shareholders to claim unpaid dividends of the years in which dividend could not be paid by the company due to insufficient profit. So in the subsequent year, when the company earns profit, they have to pay a dividend to cumulative preference shares. On the other hand, in case of non-cumulative preference shares, the holders of non-cumulative preference shares will get preference dividend if the company earns sufficient profit, but they do not have the right to claim unpaid dividend which could not be paid due to insufficient profit in a particular financial year. Next is redeemable preference shares. So redeemable preference shares are those shares which are redeemed or repaid after the expiry of a stipulated time period. Then next is non-redeemable preference shares. These are the preference shares which cannot be redeemed. However, if we see the provisions of Companies Act, it is not allowed to issue non-redeemable preference shares. The company has to issue preference shares which are being redeemed within 20 years from the date of issue. Participating preference shares. So participating preference shares are entitled to share the surplus profits of the company in addition to preference dividend and also surplus assets in case of winding up of the company. On the other hand, non-participating preference shares are not entitled to share surplus profit and surplus assets like participating preference shareholders. Convertible preference shares. So the holders of convertible preference shares are given an option to convert whole or part of their holding into equity shares after a specific period of time. Non-convertible preference shares, however, remain preference shares till their redemption, and they don't have any option to get converted into equity at a later date. So these are the types of preference shares.
And just to add one point here, if the company is looking to kind of issue these shares to a non-resident, and if the money is coming in as FDI, the only instrument that can be issued is compulsorily convertible preference share, which is kind of the only instrument in terms of all the different types of preference shares that we just read. But RBI only permits compulsory convertible preference shares to be issued to a non-resident if they are putting in FDI in the company.
So compulsory convertible into equity, that is so that it is equity capital is there here. Okay.
So what are the benefits of preference shares to the company? So preference shares are the instruments which are used by corporates as a long-term source of funding their projects. So they are known as hybrid instrument because they have characteristics of both equity and debt. So some of the advantages are no legal obligation for dividend payment. Like in case in a particular year company is not making profits, then they need not necessarily be paid dividend to the preference shareholders. It improves borrowing capacity. Since it forms a part of capital of the company, the net worth gets increased and it improves the borrowing capacity for a company. No dilution in control. As we say, the preference shareholders do not have voting rights on all the matters. There is no dilution in control. Unlike Rahul sir explained that in case we have articles allowing the provision that the preference shareholders can vote on all matters. Further, no charge on assets. So they do not have any charge on the assets of the company. Some of the disadvantages are costly source of finance. Since there is a fixed rate of dividend involved, it is a costly source of finance for the company. Skipping dividend on preference shares can disregard the market image of the company, and they do have preferential claims over the company in case of liquidation. So these are some of the drawbacks.
I will just talk here about one particular point where it says no dilution and in control. So I'll just tell you like how it kind of plays out in the practical scenario. Especially when an investor puts in money, we have already discussed that they put in the instrument that's given to them is compulsorily convertible preference shares. And when it's compulsory convertible preference shares, we usually fix a conversion ratio for that particular preference share. And typically it's 1:1. So at the time when the compulsory convertible share will convert to equity, it will convert into one CCPS will convert to one equity share. But think of a scenario where an investor has got compulsory convertible preference share with a 1:1 conversion. And tomorrow another next round is happening at a slightly lesser valuation, where someone else is coming and putting the same money and getting more shares of the company. So how does the current investor protect their percentage holding in the company? So that's where the preference share comes into the picture. You can actually, under the law, change the conversion ratio to adjust and ensure that instead of that investor getting one equity share, they may get a little more equity share. So the conversion ratio will not be 1:1. It can be 1 point something, which would ultimately adjust into a whole number. And that, I mean, there is a calculation that goes into there. But that's one of the typical ways in which the dilution is controlled through a preference share for an investor.
Interesting. Thank you. Yeah.
So let us now see some of the conditions which are for issuing the preference shares. So the company has to check whether its authorized capital is sufficient for issuing the preference shares, or it may have to reclassify or increase its authorized share capital. It has to check whether there are enabling provisions in the articles of association which allows the company to issue a preference shares. Further, there is no default in redemption of already issued preference shares. So if the company has issued preference shares earlier, there should not be any default in redemption of those preference shares. If it's there, then the company cannot issue further preference shares till those are redeemed. No default in payment of dividend. There should not be any default in payment of dividend. Tenure of preference shares. The company has to keep in mind the tenure of preference shares, that it cannot exceed 20 years. So these are some conditions for issuing preference shares. So let us now talk about procedure for issue of preference shares. So before going into procedure, the company has to decide the quantum of preference shares and the value price at which the preference shares will be issued. So this price has to be arrived at based on the valuation report of registered valuer as per the Companies Act. And if you are issuing shares to the foreign investor, then a report of merchant banker is necessary. So after deciding on the price, the company will call for the board meeting by issuing notice as per the statutory limits, then convening a board meeting in which the board will approve the issue of preference shares, then the other terms and conditions, also the supporting documents like the offer letters and valuation report, everything. In the same board meeting, the company will approve the notice of general meeting, which has to be sent to the equity to the shareholders within 21, like minimum 21 days before the general meeting. It can be at shorter notice after obtaining the necessary consents. Then convening a general meeting in which the shareholders will approve the issue of preference shares. Immediately after the general meeting is convened, the company has to file Form MGT 14 with the Registrar of Companies. As before filing from MGT 14, the company cannot circulate the offer letters to the shareholder investors. It's a condition of one of the condition of private placement of shares. So after circulation of offer letters, the company will give certain time to the shareholders within which they can apply. So the investors will apply and send the share application money. Once the application money is received, the company has to allot the securities within 60 days. So they will hold another board meeting or it can be passed through a circular resolution also for allotment of securities to the preference shares to the investors. After allotment, the company has to file Form Pass 3 with the Register of Companies within 15 days from the date of allotment. Then issue of share certificates, payment of stamp duty on the share certificates, and then making relevant entries in the Register of Members. So when we are talking about procedure for issue of preference shares, let us understand some of the important matters that has to be included in the resolution and the explanatory statement of the notice of general meeting. So pursuant to Rule 9, Sub-Rule 2 of Company Share Capital and Debentures Rule 2014, a company issuing preference shares shall set out in the resolution particulars in respect of following matters with respect to such shares, which should include the priority with respect to payment of dividend or repayment of capital vis-a-vis equity shares, the participation in surplus funds, if any, the participation in surplus assets and profits on winding up, which may remain after the entire capital has been repaid, the payment of dividend on cumulative or non-cumulative basis, the conversion of preference shares into equity shares, voting rights, and the redemption of preference shares. So these all matters have to be keep into mind while drafting a resolution. Then, pursuant to Rule 9, Sub-Rule 3 of Company Share Capital and Debentures Rule 2014, the explanatory statement which is to be annexed to the notice of general meeting pursuant to Section 102 shall provide complete material facts concerned with and relevant to the issue of such shares, which shall include the following items: the size of the issue and number of preference shares to be issued and nominal value of each share, the nature of such shares, that is cumulative or non-cumulative, participating or non-participating, convertible or non-convertible, the objects of the issue, the manner of issue of shares, price at which the shares are proposed to be issued, and the basis on which the price has been arrived, the valuation report which the company has obtained. So details of that has to be mentioned. The terms of issue, including rate of dividend on each shares, etc. The terms of redemption, including tenure of redemption, redemption of shares at premium, and if the shares are convertible, then the terms of conversion of shares. The manner and modes of redemption, current shareholding pattern of the company, and expected dilution in equity share capital upon conversion of preference shares if the preference shares are convertible. So these all matters are mandatory to be included in the explanatory statement of the notice of general meeting.
This is a very, very important disclosure. I think Rahul will add to this. But one thing I would like to bring to the notice of the fatality here. Very recently, the adjudication officers are scrutinizing the document based on the filing done by the various companies. Wherever the explanatory statement is not mentioned, the required disclosures, adjudication notices have been issued and the companies have been heavily penalized. That is one. Second thing is again coming to the calling of the meeting in 21 days notice or shorter notice. I come across very recently in one of the companies, it was a foreign subsidiary company. They called the meeting. Probably they called the meeting on the same day. In the morning, probably they decided to have the meeting in the afternoon. So what has happened is in this particular case, they did not apply the shorter consent. Adjudication officer has taken very seriously this matter. He issued the notice. Hey, you are not even given the notice. 21 days notice is not given, or shorter note consent is also not taken. Ultimately, the company has to pay a heavy amount of the penalty. So the dropping of the notice to the AGM and the necessary disclosure plays a very, very crucial role. You have to keep in mind, you have to have the checklist. You have to work with the checklist. What are the requirements? What are the law? What is the mandatory requirement? You should not miss out anything. Rahul, you would like to add something?
Yeah, definitely, sir. I think this is a very critical point, and especially for us company secretaries, whose crucial role is to ensure like proper compliance and corporate governance. One is definitely the sword always hangs from the regulator side, but that's just not it, because today's companies are always subject to different kind of due diligences. So tomorrow the company might be getting some investment from some prospective investor. So even from a due diligence point of view, these things are looked into like in very like minute details. So these gets kind of flagged if not properly kind of disclosed. And then obviously, I mean, the making this correct, it's like near to impossible. So once these things are kind of missed from our compliance point of view or from a disclosure point of view, so it becomes almost near to impossible to get this corrected or rectified. Even if we come up with some kind of a solution, it's only a temporary solution, and especially when it goes to the regulator, they'll be very like non-merciful in terms of treating these non-compliances. So as sir rightly said, obviously the regulators are there, but not just the regulators. Investors keeps doing due diligences on companies quite often, and these things gets picked up very easily when due diligences happen. So we need to be very careful when we are giving any disclosure, ensuring that whatever disclosures are prescribed in the rules, we disclose it. If some of the points are not even applicable, we should put the point and mention that this is particularly not applicable for this particular class of security. But adhering to disclosures and correct disclosures is it's non-negotiable.
Yeah, there's your point of not applicable also specifically mentioned is a good suggestion. That's a very good suggestion. Thank you. Yes.
Let us see some of the rights of preference shareholders. So when we talk about rights, the first thing comes into mind is the voting rights. So the preference shareholders have right to vote only on the resolutions placed before the company which directly affect their rights that are being attached to the preference shares. Further, any resolution for the winding up of the company or the repayment or reduction of its equity and preference share capital. For their voting rights on poll shall be in proportion to shares in the paid up preference share capital held by them. As we discussed earlier, in case the dividend on preference shares has not been paid for the consecutive period of 2 years or more, then the preference shareholders get right to vote on all the matters which are being placed before the company. Another right is the right to receive notice of general meeting. So one of the question comes in mind when we are issuing notice of general meeting, does this mandatorily required to be issued to the preference shareholders? So yes, pursuant to section 101 subsection 3, the notice of meeting should be sent to the member of the company, legal representative of any deceased member, or the assignee of an insolvent member. So when we see about the definition of member under section 2 subsection 55, member includes both equity and preference shareholders whose name is entered in the register of members and as the beneficial owners in the records of depository. So yes, preference shareholders are entitled to participate receive the notice of general meeting, entitled to participate in the general meetings, but they can only vote on the matters which affect their right.
Yeah, but in addition to, as per the article, as Mr.
Yes.
Rama mentioned that.
Yes, yes.
And just a minute, Suchita, participants, please note that put your questions, suggestion in chat box. We'll answer them everything. And as regards raising of hand, we will allow everyone who raised the hand at the end of the session for better administration and time management. Thank you. Yes, Suchita, carry.
So let us talk about dividend on preference shares. So the preference shares carry preferential right to dividend in accordance with their terms of issue. This right is not to receipt of dividend, but to preferential treatment of dividend in if and when the dividend is declared by the company. So since the dividend on preference shares is governed by the terms of issue of preference shares, the board may declare dividend on in accordance with the terms. In case of interim dividend, whenever the company is declaring interim dividend to the equity shareholders, it is not mandatory to pay interim dividend to the preference shareholders. However, dividend on preference shares will be paid based on the fixed percentage as may be agreed at the time of issue of preference shares. So this is all about issue. Now we'll start with redemption of preference shares.
I think before that we can address some of the questions which have been raised, I think so.
Yeah, please.
Yeah, we'll just have a look at it. Somebody has put a question, what does mean sufficient profit?
Mr. Rahul, you will take it. We are telling no that dividend will be declared if there is sufficient profit. So they are asking what is sufficient profit.
I think we just need to go by the language which is provided in the section in terms of distribution of dividend, in terms of what is profit as per the Companies Act. I don't think so there is any place of interpretation there. Whatever is the definition of profit in terms of the section on distribution of dividend, we just need to blindly go by that interpretation.
Yeah, in fact, in a common understanding, when you say the sufficient profit, company has to generate the profit in such a way because there are certain things which they are required to meet. That means, the remuneration is always linked, not exceeding so much percentage of the profit, which is 11%. And again, the executive commission. So these are all the things which are there, they should be able to meet. That is number one. Number two, in case of the preference share, whatever the committed dividend is there, they should be able to meet. And over and above, they will also able to reward to the equity shareholders. Because many times, if you have seen managerial remuneration, if the sufficient profit is not there to meet this requirement or something like that, then in such a case that minimum remuneration has to be paid as per the paid up capital, etc. That is mentioned there. Sufficient profit in a common understanding means surplus enough of money which should be able to meet all the obligations of the company. Not only that, even if the company needs some sort of the surplus amount to be carried forward towards the working capital, they should be in a position to generate. That is what it would mean sufficient profit. As the Rahul puts it, otherwise we'll have to go by what is the definition which is actually put.
Akshay, you want to add anything? Akshay?
No, nothing from my side on this.
Thank you. We can go ahead, Mr. Bala.
Is the payment of dividend mandatory if a company makes a profit?
Should I go ahead?
Is the payment of dividend is mandatory if the company makes a profit?
No, so I think it's a very clear answer. So the answer is no. But if the company declares dividend, then they have to go ahead and make the payment. So they can't back out if once they declare the dividend.
Yeah, absolutely. You're right. Actually, it is, according to the board of directors decision, what is to be given. If they feel the company need to retain the profit for the future requirement, they can retain, they can skip the dividend also. There have been companies which have been actually doing that. But the only thing is here is when it's come to the preference share, since it is the committed amount of the dividend, that has to be declared. Whether the non-cumulative preference shareholder also get the right of voting under section 47 for non-payment of dividend for 2 years. Yeah, That is right. That's what she explained actually. If the dividend is not paid for consecutively for the 2 years, they get the right to vote in all the matters which are actually there in the company. That's what she explained to you.
No, what they are asking,
Yeah.
cumulative, it is compulsory that they get a right to get dividend in the year when the dividend, the company makes a profit and declare dividend for earlier years. So what is the question in case of non-cumulative preference shareholders? Still they get a right if they don't pay. That is the question. So that's why they are asked non-cumulative specifically and accordingly asked. So yes, it will be preference shareholders. If they are not paid for 2 consecutive years, they are entitled to voting rights.
Yeah, that is right.
Any kind of preference.
One connection of the Companies Act 2013, company is not allowed to issue non-redeemable preference share. Yeah, that is right, because the preference share cannot be issued non-redeemable at all at any point of time. In any case, the maximum period of the period will be 20 years, as she said, barring from the infrastructure company where it is more.
See, mentioned in a slide and immediately mentioned also, now it is not possible as non-redeemable, maximum 20 years. He mentioned that also in that.
Correct.
He is referring to our slide. Yeah, next.
Do you mean redeemable preference share is not allowed to be issued to a non-resident?
See, so when you say non-residents actually can invest in 2 ways. So if you're aware of the way the money comes from outside, so NRIs can actually have 2 kind of accounts in India. One is called an NRO account and one is called an NRE account. NRO account is the account which is held by, I'm talking about NRIs, which is treated as Indian money and not FDI. So if the investment they are making is through the NRO account, in that case, company can issue any kind of preference shares. However, if the company is issuing shares where the investment is made by the non-resident Indians through the NRO account or to non-residents, which is a pure FDI, in that case, it has to be only compulsorily convertible preference shares and not any kind of optionally convertible preference shares. Also, the reason being why RBI kind of makes it mandates that any amount of any kind of shares which is issued to a non-resident has to be a compulsorily convertible shares is to ensure there is some form of assurity in terms of how much holding a foreigner will have in an Indian asset. So government is very particular in terms of foreigners holding assets in Indian company. So just to ensure the percentage of holding once all these shares gets converted, that's the reason they have made it mandatory that if it is to a foreigner who is investing through FDI or an NRI who is investing through a NRE account, it has to be only compulsorily convertible preference shares.
And don't you think, Mr. Rahul, it becomes take a color of borrowing as such, and borrowing under FEMA has different compliance because it is
True.
compulsorily repayable.
True.
And there is whatever percentage of interest compulsorily. So it take more color of borrowings, which has different compliance under FEMA.
Correct. I mean, then you go and comply under your external commercial borrowing guidelines.
Yeah.
So you're absolutely correct. That's one of the reason why it's made to only issue CCPS to non-residents.
They are optionally convertible, redeemable preference share, convertible at the option of the issuer, the issue. Yeah, that is the whole idea. The optionally convertible is giving an option to the issuer. If he wants, he can exercise his option. If he doesn't want, he need not exercise the option. That is the answer. Is it possible to change the conversion ratio in case of the non-resident without RBI approval?
Is it possible to change the conversion ratio? You mentioned that if in future it is coming.
Yes. It's possible. What we do is practically, it's very common for especially non-resident investors who are holding CCPS in Indian companies that the conversion ratio keeps getting changed. So what we do is whenever there is a change in the conversion ratio, earlier we used to suggest companies to do at least a plain paper reporting with their AD. Now that since the any kind of physical communication is kind of discontinued with the authorized dealers, we have got suggestions sometimes from some banks or some authorized dealer is to go and amend the entity master form. So you know that the reporting to RBI is done through two kind of dashboards. One is the entity master form and one is the SMF, what we call, where we keep filing FCGPR reportings. So EMF is one where the entire cap table of the company is reported on a fully diluted basis, assuming that all the preference shares issued to any investor is kind of converted and reported in equity. So whenever there is a change in the conversion ratio, many authorized dealers have actually told us to go and amend the entity master form, because that will have an impact in the resultant number of equity outstanding holdings. But again, many authorized dealers have kind of told us that you don't need to kind of go and report anything. So it's again up to the authorized dealer, but there is no formal regulation which says that specifically if there's a change in the conversion ratio, you need to go and report to RBI.
Interesting question, Mr. House, and interesting answer. Thank you, both of you. Yeah, Mr. Bala.
Whether in case of the redeemable preference share, example 2 years tenure, interest dividend, that is coupon rate, is allowable under income tax.
What is
Sir.
upside? Yeah.
Yeah, what's the question, sir? It's
Whether in case of the redeemable preference share, example 2 year tenure, interest stroke dividend, that is coupon rate, is allowable under income tax.
yeah, it is allowed under income tax only if it is paid.
Yeah. Okay.
Yeah.
Thank you.
Being a risk capital, in situation of the inadequacy of the profit for successive years, redeemable preference share are not redeemed. The holder are in an unenviable position under the Act. They can demand redemption, they can file for liquidation, they can vote unless the share carry right of the dividend, and for 2-year dividends are not paid. Why should an investor be interested in this?
They cannot. So I will say that being a risk capital, in situation of inadequacy of profits for successive years, redeemable preference shares are not redeemed. The holders are in an inenviable position
under the Act.
They can't demand redemption. They can't file for liquidation. They cannot vote unless the shares carry right to dividends. And for 2 years, dividends are not paid. Why should an investor be interested? It's why.
See, very first
I
thing
think
is.
Mr. Rahul.
No, very first thing is saying the company is actually having an inadequacy profit for successive years. If the company is having inadequacy profit, the investor know very categorically that the company is not in a position to make a payment. Why should the investor go himself?
No.
He himself has given the answer in the very first line entry. Inadequacy of the profit successive years.
So then they get a right as a equity shareholders.
Yeah, after 2 years.
We mentioned that if that is not paid for successive years. And the moment they get right as equity shareholders, they can file for liquidation also accordingly. And where is the question of redemption? The thing that the company is not having fund. So as a equity shareholders, they can decide on the right. Mr. Rao, sorry, you should answer.
No, I mean, Dev, I think both of you have kind of answered this question. And I mean, assuming that it's an investment, investments are always subject to risk. So there is never a assured return. So at the first place, when an investor is investing, he is investing with the knowledge or with the assumption that this investment may not give him the sufficient return. So what we do is in such cases whenever like especially lawyers are representing investors, we try to build in some kind of protections for the investor. As I said that just to ensure that they have the ability to do some adjust to some of their conversion ratios. Voting rights are being made in par with equity shareholders. Ensure that they have enough governance right or say in the board in case they have a significant holding in the company. So some of these protections are not always what the act allows, but a little over and above what the act allows, and these are always put in discussion with the company. So these are just ways of kind of ensuring that the investor rights at least are protected. Supposedly, if the investment doesn't go well, and at least they can come back and question the company on these things. But if the company itself does not have inadequate profit, ultimately it's a loss for both the founders and the investors.
Yeah, Mr. Bala.
To downtown, and there is an adjustment of the conversion ratio of CCPS. How does the valuation play out legally? There must be a old valuation report when the compulsory convertible preference share was issued, and later due to downtown, the conversion ratio changed, which technically violates the old valuation report legally.
Yeah. I'll just take the question. So I think it's a very interesting question, and I think it's important to know that while we adjust the conversion ratio, what all we should keep in mind. So especially when we are seeing a situation where we are issuing the shares or a compulsorily convertible preference share to a non-resident. So the pricing guidelines or the first principle in FEMA says that you should not issue shares at a price which is lesser than the FMV, which is determined at the time of issuance. Now, if we consider a situation that today my FMV is 200 rupees and I'm issuing shares to a non-resident at 200 rupees. Tomorrow, if there's a situation where the down round happens and if the valuation falls below 200 rupees, now if I adjust the conversion ratio, my resultant equity shares per share FMV will actually fall below 200, which will go against the pricing guidelines or the very basic principles of FEMA. So what usually we keep in mind is that whenever we issue shares to a non-resident, especially if it's a FDI investment, we always keep some buffer over and above the valuation determined at that day. So if the valuation of the FMV is determined at say 200, we will always issue the shares not at 200, but at 300 or 400, because FEMA nowhere says that you can't issue over and above the valuation price till I'm not discriminating between a resident and a non-resident. So that buffer which is there, or the delta which is there at the time of issuance between the valuation price and the issuance price actually gives us the room to do the conversion adjustment tomorrow if the price per share falls. But nowhere can I go below, make an adjustment where my resultant equity share value goes below the valuation price at the time of adjustment. So the base or the floor for my conversion adjustment would always be the valuation which I have obtained at the time of issuance of that particular security. No matter, even after 2 years down the line, I go and do some conversion adjustment.
Okay, thank you.
Really a very interesting experience, Ram.
Yeah.
Insight you are actually given. Renewable preference share 2 years issue at par and deducted at premium. Whether premium paid on redemption when no coupon payment is allowed under Income Tax Act. I think this you actually answered earlier. Whether the company can issue preference share on the right basis, the answer is actually yes, and she is going to discuss in the future slide. There is no issue. When a preference share converted to the equity share 1:1, is the extra in equity allotted equal to dividend and taxable inviting TDS also. I think the tax aspect also being discussed later. If a company issue compulsorily convertible preference share or compulsory convertible debenture in a non-pricing round, where the conversion is based on a formula as a discount on the future round with the cap, is valuation report mandatory while issuing? If yes, how?
Yes, actually it is yes. So many a times for a non-priced round, we issue compulsorily convertible preference shares, but we do obtain a valuation just to ensure that the valuation which would be determined at the future date to fix the conversion ratio will not go below the valuation which has been procured at the time of issuance. So you can say just to determine the floor or the base valuation, a valuation report is required, especially when you are issuing convertible compulsory preference shares for a non-priced round.
Mr. Rahul seems to be from venture capital only.
No, he has got a vast experience.
One
He went
Rahul to
to-
another Rahul. Rahul Saria, one after the other is.
Okay. In what circumstances the preference share can be redeemed prior to the maturity period?
I think it's clear. I think that what the law says is that it's up to the option of either of the company or the shareholder or any event which has been discussed between both of them. So if any of those events trigger, you can always redeem it prior to the maturity period. But I'll just leave it to sir or madam if you want to add anything
No,
else.
it's all depends upon the company. But the company is in a position to the cash rich company, they generated more cash, if they want to redeem. It is of the option, they can do that. Because as law does not say anything, it can be done anytime. So it is all the company takes a call.
Yeah. And your terms should be clear. We have decided that your terms should be clear and she mentioned what all you should be disclosing, and in that everything is covered. So as per terms, you have to do it.
Whether
Yeah.
the premium paid redemption is treated as a dividend under section 222 and liable for TDS under section 194.
I think we can take there is a separate.
Yeah, taxation.
Yeah, we
Taxation.
have covered accounting and taxation at the end of this presentation. So
So
Okay.
we will take after that, if question is left.
Yeah.
We can.
What is the minimum tenure for which a redeemable non-convertible preferred share can be issued? Maximum tenure is 20 years. But what is the minimum?
My understanding is law. I don't think anywhere prohibits for a minimum
Minimum
tenure.
is not, but interesting it is. What it is minimum? Very. I have also not thought. Let me be very frank.
But one thing is there, when you talk about the preference share, it is always, as per the accounting standard, it is a long-term borrowing. So keeping in mind, I don't know whether any short-term will
And
be, yeah.
And any issue or raising of funds has some purpose. You cannot just raise it for just sake of it. You have to mention something. So that purpose cannot be today I raised and can be achieved in 10 days or a month or kind of thing.
So I can tell you, like for venture capital deals where it's mostly again CCPS which is issued, we keep a standard tenure of 19 years, assuming that at least that 1 year we'll keep it for kind of taking all corporate actions to redeem that share. So we keep a standard tenure of 19 years for all investment deals.
Okay, thank you.
How does the safe notes work in India? As the safe is not recognized instrument under the company's law, do they issue CCPS only?
So there is no concept of safe in India. Safe is usually it's a US concept. So in India, the alternate to safe is actually CCPS only.
Is reverse,
Sorry, Mr. Bala, can you
Yeah.
highlight for participant what is safe? Everyone may not be knowing. Mr. Rao.
Yeah. So safe is called a simple agreement for future equity. It's a US concept, and I think which was kind of popularized in India by YC Combinator. So the thing is, the CCPS is kind of structured. So I think someone had asked that question earlier that about CCPS to be issued for non-priced round. So this is exactly what is being issued is CCPS. Though we can give a terminology of safe CCPS or we can call it safe in India. I mean, there is no restriction on using any terminologies to a particular kind of class of shares or instrument. But ultimately, the base instrument it's a preference share, compulsorily convertible preference share, which can be used. Actually, safe is not possible to in India. The closest thing probably what you can do in India is a convertible note. As an alternate to compulsorily convertible preference shares.
Okay.
Is reverse vesting clause SHA legal? Can someone share the reverse contractual in a SHA shareholders agreement, which has been issued under company law?
I think so. It's very much possible. So reverse vesting is nothing but you get the shares on day one, and then it vests over a period of time. So it's very common for again, I mean, slightly I think diversing from the today's topic of preference shares, but just to kind of respond to this question, most of the promoter shares are reverse vested whenever they enter into a SHA contract for the first time with an investor. And mostly it's locked in for a period of 4 years, and it gets vested over a period of 4 years. And at the end of every year, there is a cliff which gets released, mostly like 25% every year. So that's, I think, that's what I understand. Probably the question was meant in terms of what is reverse vesting in an SHA.
Right.
When convertible preference share are converted into equity share at a premium, do the company require to transfer the amount of the premium at which the equity share are issued to the CRR out of free reserves?
So I'll tell you what happens when a conversion of preference shares into equity takes place. So it's very interesting that if my preference share is of at a par value 10 and my equity is at a par value 10, can I convert it into 1:1 ratio? So that is very much possible. Now assume a scenario where my preference share needs to be converted into 1:2 equity share. Can it be converted? There are various actually interpretations in the market, but if you go as per the stricter interpretation, the answer is no, because for converting your one preference share of 10 rupees into two equity share of 10 each, you need another 10 in the capital, but you can't move any amount from your premium of preference to the capital of the equity. So what usually, how do we structure in such cases is that it's better to, at the time of issuance, keep the face value or the par value of preference share at least 20 or 30 rupees if your equity par value is 10. So at least you have the buffer to issue 3 more equity when the conversion takes place for the preference shares. So it's easy to move capital from move the money from capital to the premium account, but you can't move any additional amount from premium account to the capital account. So it's always better in such cases where you foresee that there can be a scenario where a conversion can happen in not in a 1:1 ratio or more than 1:1 ratio. It's always better to keep the par value of preference a little more than what you have for equity shares.
Thank you. Interesting. Yeah.
Kindly highlight FDI related aspect in the whole of the preference share.
I think we have covered this in earlier questions, but again, the thumb rule is that if it's an FDI, it has to be compulsorily convertible preference shares.
Yeah.
Throw some lights on conversion of the NCRPS into convertible preference share or convertible debenture.
Again, I think this is an very interesting topic in terms of changing the base characteristics of an instrument. And if you like kind of do a little bit of research, there are multiple commentaries where professionals kind of debate and they have different versions of like what should be the best way of doing it. But I think the most common at least responses or views what I've got from professionals is it can only be done under a scheme of arrangement, and that's the most legal way of doing it. But this thing I would kind of request sir and ma'am to kind of show light from their experience what they have seen.
Rather than experience side, you rightly mentioned, people say that yes, you can take preference shareholder and equity shareholders approval and can change it. But then certain people say it's a basic characteristic you are changing. It should be under scheme. Two school of thoughts are running, and safer way everyone is preferring that under scheme. but it is, you have to take a call.
Once
Yeah,
the company default in the payment of the dividend to the preferred shareholders, they cannot issue further redeemable share. But we have seen companies issuing multiple tranches. Even the company has not paid the dividend on earlier issues. Your view, please.
So I'm not sure if it's possible to kind of give a very specific answer to this question, but if the company has not declared dividends, then there is no default. That can be one scenario where even in spite of shareholders having a dividend right, if the company has not declared dividends, they can still go ahead and issue multiple other classes or the same class of shares to multiple other investors. But again, I mean, if there's a default, then it can be a non-compliance. So if that's the question, like if so the base understanding is if the company has not declared dividend, then there is no default of any payment of dividend.
I
No.
can add one more thing. If the company has declared the dividend and not paid, as you rightly say, it is a default. Even after that, you have done these things. So long as you did not get caught by the regulators, the things goes on. The day regulators get you, you are in a big trouble. Because non-compliance is always in an offense, it will be punishable. That's it.
yeah.
What are the rules for valuation of the preferred share?
I think the rules in the sense like we do the DCF valuation in terms of determining the FMV. So under Companies Act, we have to take a registered valuer report. If it's FEMA, you take either a merchant banker report or a chartered accountant report. Even under income tax, you can take a merchant banker report. So technically, there are two valuation reports that we usually see professionals take. One is the merchant banker report and one is the registered valuer report, and all this valuation is done on DCF methodology.
Yeah.
In a private limited company, if preferred shares are not converted, redeemed on due date as per the agreement due to insufficiency of the funds in the company, whether the company can extend such to further period, what procedure company should actually follow. Shareholders are agreed for this extension. As auditor, what precautions should be taken?
That's a procedure we are covering in the upcoming slides. The
Acha,
procedure
you are going to
for
discuss.
yes,
Okay.
yes, this we are going
Okay.
to discuss.
What is the range of the return in general for preferred share?
No.
I don't think there is any standard answer to this.
Standard, yeah, this word. Yeah.
Is it mandatory to give a dividend on all type of preferred share? And what in case of loss, how provisions are created?
We have discussed that if it is the profit and if you are want to declare dividend, everything.
Yeah, if it, the loss is the dividend cannot be declared, but at the same time, if the dividend is actually committed, much will depend upon what kind of the thing, whether it is cumulative, non-cumulative. If it is the cumulative, then again the unpaid dividend will be actually, reserve will be created. The year in which the profit is there, it will be paid.
Yeah. Next is minimum tenure. We discuss this next. Because
What
lot
if-
of questions are there.
What if interim dividend for equity shares and how will impact the shareholders?
Preference share. What if interim dividend declared for equity shares and how it will impact preference shares also?
See, one thing is very clear here. With the company declare interim dividend means they are having enough profit is made. That is why they are giving an interim dividend. And while calculating the interim dividend, they would have already taken into care of the committed dividend for the preferred shareholder also, because they have to take into consideration everything. So as far as the preferred shareholder is concerned, I don't think it will affect according to me. Rahul, what do you say?
No, I absolutely agree with you. I think it's a more of a logical reasoning. In considering the company is declaring interim dividend, most chances are there that they would also declare it for preference shareholders.
Rule 13G of the share capital debenture rule says that the price of the share of the other securities to be issued on a preferential basis, either for cash or for consideration other than the cash, shall be determined on the basis of valuation report of the registered valuer. Emphasis applied on the word issued. Does it mean the company need to obtain the valuation report at the issue of preference share? And again, prior to conversion. Here again, final conversion is being decided prior to the conversion event. KPMG has informed that 2 reports are needed and hence the query.
Yeah, I think if you go by the plain reading of the act, it's clear that you have to obtain 2 valuation reports.
What are the NSDL compliance required for this? We have to mandatorily provide a demat facilities by recent notification before we issue. Should we need to obtain different ISN, etc.?
I think again, I mean, slightly deviating from the main topic, but if you are mandatorily required and you are not a small company who is mandatorily required to demat all your shares or go for an ISIN, then obviously you will have to appoint an RTA and demat all your classes of shares, including even preference shares. So if you have different preference shares in the company or in your shareholding list, so you have to demat all the classes of preference shares, at least obtain the ISINs before 30th of September.
Also, can the company convert preference share into the equity share at a discount? X valuation taken prior to conversion, say 5 years from issue date. Company pre-decided the conversion of CCPS should happen 20% discount to the value arrived at the RV. Is such discount allowed?
My understanding is it should be possible.
I also think so, because as you really say, what are the terms you have agreed upon? It should be very clear while issuing the thing. Then if that is the case, it is possible. Do we need to obtain different ISIN first? Or vis-a-vis, we need to comply the valuation and filing, etc.?
See, these are 2 different things. Unless your question is that at what point of the issuance process do you need to get the ISIN? I think the obviously ISIN will follow the valuation and filings, etc. Because unless you have actually done the issuance and offered the shares and someone has actually taken up the shares of the company and being allotted those shares, the shares do not come into existence into your paid up share capital. So ISIN will always follow your entire process of issuance, including getting the valuation report and all filings, etc.
Are there any specific stamp duty for NSDL corporate actions?
NSDL have their corporate action fees. So stamp duty is as per the Stamp Act. I think.
Valuation report need to be taken from the registered valuer or CA would do. What is your view?
So you have to take under Companies Act, a CA valuation will not work. So whenever there is a share issuance, to comply with the Companies Act rules, you have to take a registered valuer report. And depending on the other regulations for income tax or FEMA, I think both of them give a flexibility of taking a CA report or an MB report. But the general preference is to go with a merchant banker report, what I've seen in all like high value transactions.
As per section 47(2), shareholders will get the voting right if the dividend is not paid for the 2 years. The period of 2 years will start from when and what is the due date? Is it March end or 1 year from the date of the issue?
I think the trigger should start definitely when the allotment has happened, because there is a significant time gap between the issuance process and when the actual shares are allotted. So definitely it would be the trigger point should be the date of allotment.
Here, Harish says, my understanding is that in case of the non-resident, if redeemable preference share is issued, then it will be governed under the ECB guidelines. Please correct me if my understanding is wrong.
Yeah, I think Madam also just had the same opinion, and so this is correct. So if it's a non-resident, you are not allowed redeemable preference shares. It may take the color of a loan from a non-resident, which would ultimately get covered under ECB guidelines.
Does it necessarily to mention the dividend percentage in terms of the issue?
Yes,
Yes.
if you ask me, yes.
Yeah, it is. It is definitely required.
So,
Yeah.
interestingly, sir, this actually is a very good point, and I would like to share. So, in most of our VC transactions, the dividend percentage, if you see, it's very nominal. It's almost 0.001 or 0.001%. And people may ask that why such a small percentage? Because whenever typically a venture capital investment happens, or say for any investor who is investing a company, more than the return he's getting on a yearly basis, he's mostly interested with the exit return that he will get at the end of a specific period, say for 10 years. So just to ensure that company is compliant with the law, the yearly percentage of return is mentioned a very nominal amount. However, they are more interested in the exit return which they get at the end of the investment tenure.
Can one CCPs having a face value of ton each be converted into two equity share having face value of ton? That I think you discussed this. Will it be certain share? That you actually elaborated. Actually, what you do?
Elaborated very well, yeah.
Yeah. Do we need to obtain the separate issue or registration before the issue of the CCPS by private placement?
I think this is a similar question in terms of, I think, getting the ISIN, if I understand correctly. So it would be obtained once the allotment is done, and the same application needs to be filed through the RTF with the depository.
Is a preference share construed as a debt or loan for in the case of the ECB?
Then we discussed that it is, but still, Mr. Rahul, you can.
No, I think, yeah, it's the same. Preferential shares depends on what kind of preference shares, and especially to a non-resident. If it's a compulsorily convertible preference share, there is no confusion. It's a capital which is coming through the capital account transaction from a non-resident under your non-debt instrument rules. If it's anything else which is not compulsorily convertible, it will take the nature of a debt or a loan, and it has to be kind of the transaction needs to follow the ECB guidelines.
In case of the optionally convertible preference share, can the company retain the option to convert or redeem? Can it be issued with the condition to redeem within a time period of 5 to 8 years or 12 to 15 years, etc.?
I don't see a restriction if it's agreed between the company and the shareholders.
Are redemption preference share treated as the interest on capital gain, and are there supporting case law to support the statement?
I think Akshar will cover it.
Okay.
So redemption of preference shares is not considered as a interest or capital gain, because we are just returning the capital which we have taken from them. So anything above the redemption value can be considered as a capital gain or a interest. That also varies on case to case basis, when what is the amount, what is the tenure, etc. So prima facie, this is not a capital gain or any interest. It's just a return of a capital that company has taken.
Okay.
Can you please touch upon the taxation impact on issue of the company in below two cases? Issuer is foregoing.
Mr. Bala, we are taking separately, no?
Okay. Okay.
And this is too much, very specific. We can't cover this way each three options. It can be general question.
Okay, I think now the question start on a reduction. Let her finish the presentation of the reduction, then we will take this. Yeah.
Yeah. So let's start with the redemption of preference shares.
Yeah.
So a company can redeem its preference shares only on the terms on which they are issued, or in case if there is any change, then after the due approval of shareholders as per section 48. The preference shares may be redeemed at the fixed time or happening of a particular event, or at the option of company or at the option of shareholders. So when we are talking about redemption of preference shares, what are the modes of redemption of preference shares? So it can be by issue of fresh shares or out of the profits available for distribution as dividend, or can be a combination of both. Some of the conditions for redemption of preference shares that the shares to be redeemed must be fully paid up. Redemption can be effected only out of profits. Premium payable, if any, on the redemption shall be provided out of the company's security premium account or out of the profits. In case a company is opting to redeem the preference shares out of a fresh issue of shares, then such issue shall be specifically made for the purpose of redemption of preference shares. In case a redemption is made out of the profits available for distribution of dividend, then a sum equivalent to nominal amount of preference shares to be redeemed shall be transferred by the company to the capital redemption reserve account. So these are the conditions. Let's talk about the procedure for redemption of preference shares. So the company has to decide the price at which the preference shares are going to be redeemed, then calling a board meeting in which the board will approve the redemption and the price and other conditions. Then convening a board meeting, informing the preference shareholders about the redemption. Like we discussed in earlier slide, if the redemption is out of distributable profits, then a sum equivalent to nominal amount has to be transferred to the capital redemption reserve account. Then making payment to the preference shareholders. After that, the company has to file notice of redemption with the Register of Companies in Form SS7 and making the relevant entries in the Register of Members. Now, what if the company fails to redeem preference shares? So in case the company is not in a position to redeem its preference shares, such preference shares will be called as unredeemed preference shares. And the company, if it is not in a position to redeem any preference shares or pay any dividend on such preference shares, then such company may, with the approval of 3/4 in value of preference shareholders and with the approval of tribunal on a petition being made by the company, issue further redeemable preference shares with respect to unredeemed preference shares, including dividend if any payable on the same. Also, the tribunal has a right to order for the redemption of preference shares who have not given their consent for issue of further redeemable preference shares. Rights available to preference shareholders in case of failure to redemption by the company. So when the act of non-redemption by the company seems to be an intentional act, the preference shareholders can file a class suit action under Section 245 or a suit for operation and mismanagement. In their capacity as a shareholder, the preference shareholders may seek an order for winding up of the company on just and equitable grounds. Further, in terms of issue of redeemable preference shares so permit, the preference shareholders may sue the company for damages for ordinary breach of contract for not redeeming the preference shares on due date. Also, they may even seek conversion of preference shares into equity shares or debt. So these are the rights available to preference shareholder in case the company fails to redeem preference shares. What are the drawbacks for the company if they do not redeem or fail to redeem the preference shareholders? So if the company fails to redeem the preference shares, then there is a prohibition on undertaking buyback of securities for 3 years after such default exists pursuant to Section 70, subsection 1C. Further, fresh issue of preference shares cannot be made unless the previous preference shares which are not being redeemed are redeemed by the company. In case of listed redeemable preference shares, disclosure of default shall be required to be made to the stock exchange. Since we are not covering LODR in detail, we will not discuss in detail here. However, the company has to make the necessary compliances as per LODR regulations. Such unredeemed preference shareholders cannot be called creditor. Also, it should not be considered as a debt. So these are the drawbacks for the company if they fail to redeem the preference shares. Let us talk about bonus issue of preference shares, whether it is possible for to issue preference shares as a bonus issue. So yes, as per Section 63, subsection 1, a company may issue bonus shares to its members. If we go through the definition of member pursuant to Section 2, subsection 55, which we have discussed earlier also, member in relation to company means subscribers to the memorandum who agree to become a member and their name is entered in the register of members. Every person who agrees in writing to become member and name is entered in the register of members. Also, every person holding shares of the company and whose name is entered as beneficial owner in the records of depository. Hence, company can issue bonus shares to preference shareholders as preference shareholders are considered as a members of the company, and there is no restrictions under Section 63 that the company cannot issue bonus shares to its preference shareholders. Rights issue of preference shares. So rights issue is basically an invitation to the existing shareholders to purchase additional shares in the company in proportion to their shareholdings in the company. Accordingly, the rights issue can be made to the preference shareholders based on the existing preference shareholders held by them in the company. I will cover the procedure for rights issue in brief. So the company has to convene a board meeting in which the company will approve the proposal for rights issue of preference shares. Then issuing letter of offer, the company has to decide the time period of offer, which should not be less than 15 and more than 30. So before opening of the offer, the company has to issue letter of offers to the shareholders at least 3 days prior to the opening of the offer. Then receiving share application money from the shareholders, convening the second board meeting for allotment of shares, and filing of Form Pass 3 with the ROC. After allotment, issuing share certificates and payment of applicable stamp duty on the share certificates. Accounting treatment of preference shares as per Indian AS, whether it is equity or liability. So in detail, accounting treatment we are going to cover in the later part of the presentation. So I will explain in short. If an entity issues preference shares that pay a fixed rate of dividend and that have a mandatory redemption feature at a future date, should be recognized as a liability in the balance sheet. For the preference shares that do not have a fixed maturity and where the issuer does not have a contractual obligation to make any payment are recognized as equity. So here we can say compulsory convertible preference shares, which are going to be converted into equity at a later date. So it is to be considered as an equity. I have covered one of the case study, which is Bank of Baroda versus Urban Offshore Limited. This is with respect to redemption of preference shares. So the facts of the case are the appellant being preference shareholder have filed an application to NCLT for redemption of preference shares under section 55(3) or section 245. NCLT Chennai bench has dismissed the application of appellant solely on the ground that the appellant being preference shareholders has no locus standi to file application for redemption of preference shares under section 55(3) or even under section 245. Aggrieved by the order of NCLT, the appellant filed an appeal to NCLT. So the legal question involved is whether there is any remedy under law available to preference shareholders for filing application for redemption of preference shares. So the decisions of NCLT held that preference shareholders are not remedialist for redemption of preference shares. They can file an application under section 55(3) of Companies Act, or alternatively, they may also file an application under section 245 as a class 2 action. So the reason behind this is the intention of section 55 is very clear that the company cannot issue irredeemable preference shares. It has to issue a redeemable preference shares which are to be redeemed within a span of 20 years. And though there is no relief which can be sought by the preference shareholders in case of non-redemption, as the intention of legislature is very clear, the tribunal has power to decide, and the preference shareholders coming with a definition of member can file the suit against under section 245 and also an application under section 55 for redemption of the company. So just to conclude, this is not ending here. We are going to continue with the accounting treatment. However, to conclude, I can say that preference shares are the perfect instrument for a company which is looking for an investment without diluting voting rights and control over the company. On the other hand, it offers the preference shareholders fixed income and priority in dividend and the repayment of capital at the time of winding up of the company.
But to add that further, that as Mr. Rahul said, that with the changes in the articles and all that, various changes can be made. So in addition to whatever features you have concluded. Yeah.
Yeah. So I will hand over to Akshar. He is going to explain on the accounting aspects of preference shares. Akshar, over to you.
Yeah, sure. So we'll be discussing the all the accounting aspect of the preference shares and something regarding the valuation of the shares company and the taxation impact of the preference shares. So
Can you
we have
switch
all,
on the video?
yeah, I have turned it on, but somehow it's not.
Okay,
Yeah.
go ahead. Yeah, now it's.
Yeah. So Suchita has already informed us, like she's already given a brief about the preference share, that preference share holders they have a priority, privileged priority. They have a prior right on in case of liquidation, fixed return, a good convertible option, and it gives a good stability to investors. So Rahul also informed us that in the most of the VC and private equity, people generally go for the CCPS or preference shares. These are the instrument majorly used in case of the fundraising. So Suchita, can we go to next slide? Yeah. So preference share is a very unique instrument which is widely used in to raise the fund in current scenario. It gives a privilege and priority over other instruments. It is a different accounting taxation impact, and it covers also a valuation. Covers the full company valuation, and it helps the company to take a decision, to structure the capital, that how much portion we should go for a preference debt. So it is a very unique instrument which is widely used by the investors. So this is just a brief of the preference shares. Can we go to the next slide? So Suchita has covered the full procedure to issue a preference shares and the filings required to be done with the ROC. So when we close the books of accounts, so as per the Ind AS, the preference share has a different treatment. Like Ind AS 32 defines the definition of the instrument, like whether how we should consider the instrument as a equity or a liability. So based on the characteristic of the instrument, the preference shares is just a name. So India's 32 says that the whatever is the instrument's character, from that first we will derive whether we will consider it as a equity or a liability. So we have to classify the preference share based on the characteristic as per the 32, and we will show it into the balance sheet. Ind AS 109 specifically says that whenever we have issued the preference shares, it has to be recorded on the fair market value. So when there is a keep on that. When there is a book closure, that time all the preference shares which company has issued or some company has shown it as an investment, so either side, so they have to revalue the preference share based on the company's performance, and the fair market value has to be recorded as per the Ind AS 109 in the books of account. And Ind AS 107 gives a detailed description that what are the disclosure are required for the preference shares or the any instrument, that whether it is their terms, the dividend, the fair value, the effective rate of interest that been considered for the issue of shares, at what value the shares are issued. So these are the major India standards which specifically concentrate on the financial instrument, and preference share is considered as a financial instrument in as per the India's. Next slide, please. Yeah, so we have covered the first two in the first slide. So major in Indian GAAP, so normal accounting standard 32 covers up the financial instrument. So preference share as a financial liability. So when we take the redeemable preference shares, and when the part of the preference shares which is going to be repaid to the investor, in that case we will consider this preference share as a liability, and we'll have to show it under the long-term liability in the balance sheet. So that is the same in case of India's 32 as well as in IGAP and the other Indias. Both the Indias and the IGAP has the same provision with regard to the recognition of the preference shares, except India's 107, which required more detailed description and disclosure with regard to the issue of preference share, where the normal IGAP is little silent on the major disclosure requirements. So this is the preference share when we have to treat it as a liability because we have to repay it off. Next. So when we issue the CCPS, like compulsory converted into equity, compulsory convertible preference shares, that time we don't have to repay it. So in that case, that preferential will be considered as a equity. So when we'll present it in a balance sheet, it will be under the equity, the equity or shareholders fund. It will reflect in the equity as a shareholder fund. Otherwise, we have to show it as a liability. So all these standards are similar in presentation of the CCPS or compulsory convertible preference shares. So treatment is same under NDS as far as the IGAP is concerned. Next. So this we already discussed that NDS 109 requires a more disclosure, like significant risk, management difference, and what kind of difference is there. If there are, so say, different preference share series, like series 1, series 2, what are the difference between two, what are the conversion ratio? If there is a difference, then we have to disclose everything under the notes to the account of the financials. Next. Yeah, so major the main concern when we go for a issue of the preference share is the valuation. So there are major three areas where we have to check the valuation. The valuation we required is under FEMA for income tax and companies act. So RBI says that whenever we issue the preference shares or any instrument, the valuation certificate has to be taken from the merchant banker only. We cannot, take the valuation report from the registered valuer. It has to be taken from the merchant banker, and when we issue the shares, the valuation certificate should not be older than 90 days. So RBI specifically mentioned that it is mandatory to take it from the merchant banker. Whereas income tax says that you have to take the valuation certificate from merchant banker if you are issuing the shares and the valuation report is made with the method of DCF. So if we are valuing the company based on the DCF valuation, in that case, for income tax purpose also, we have to take the valuation certificate from the merchant banker and not from the registered valuer. If we use some other valuation method, say income earning method or book value or other net asset method, that time the valuation certificate from the registered value is allowed. But DCF method, income tax will also not entertain the valuation certificate from any other merchant banker. And Companies Act is silent about the valuation report. They require only the valuation report is required when you go for any right issue or preferential issue. So these are the valuation rules, because if we just overvalue the share or undervalue the share, we do receive the notices from the income tax asking for the basis on which you have done the valuation. Because nowadays startups are, the face value of the shares is 10, and we are issuing the shares at 7,000, 10,000, 15,000. So regulatory do ask the question to registered valuer and the merchant maker on what ground the valuation was derived. So valuation is very important aspect of the this right issue and preferential basis. Next slide.
In that case, it is better to take because both FEMA and tax income
Yeah,
tax.
so Rahul
merchant banker and
rightly
DCF
mentioned that generally we take two reports. So one is from the merchant banker and one is for the registered valuer. So all the funding round people generally take two reports. However, where there is a transfer of shares, that time the valuation report differs for the income tax. Income tax has given another valuation method where there is a transfer of shares. So that is a book value method, and they have given the formula also. So that time that can be issued by the normal CA as well. That time the it's not required to be taken from the registered valuer. But all the funding round people take two, valuation report. One is from the registered valuer and one is from the merchant banker.
and DCF
So,
method is successful.
yeah, DCF method is required. In case of transfer of shares, the DCF is not required. So whenever you transfer,
Preference, issue of preference.
yeah,
Can we say so long as RBI is not involved, FEMA regulations are not coming into the picture, can we say that we can take the valuation from the registered valuer?
yeah, provided you don't value the share based on the DCF method. If you use any other method, then you can take. But if you use the DCF method, then again you have to take it from the registered value, because income tax has very much clearly mentioned it has to be from the merchant banker only.
Okay.
Yeah. So taxation aspect of the preference shares are easy. When the preference shares are compulsorily convertible, we consider it as a equity. So when we give the dividend to those preference share, then we have to company has to pay the dividend distribution tax, because it is as good as a dividend is given to equity shareholder. When we give the dividend on interest to a preference shareholder which are redeemable, that time it is treated as a expense and we can charge it to a P&L. And there is one more concept of angel tax implication. When initially when the company right now there are so many startups which are coming for fundraising, and very initial stage they value the company which is much more higher than 2,000 crore, 4,000 crore. So income tax has introduced one concept called angel tax. So in that case, when we issue a shares which is at a higher than the fair value, so difference between the fair value and the issue price is considered as an income, and income tax will directly charge the 30% tax on that. It is considered as a deemed income because you are getting the money over the above than your valuation. So that's the angel tax, that when we issue a share and when you do the valuation, we have to keep this in mind, because if there is a difference between the fair value and the issue price, we'll have to pay the tax on all the premium what extra we have taken from the investor, and income tax will charge on the tax on that. So next slide, please. This Rahul has already explained us why people choose the preference as a instrument when they want to invest in any company. So widely people are using the preference share as an instrument to invest the company, because it gives them both the right right to vote and preference over other thing. And whenever there are funding round happen, people do execute into the shareholder agreement. In that they mention the different rights of the preference shareholder, and accordingly we have to amend our article as well. So this rights, whatever right procedure, whatever is taken into consideration in the SHA, we have to consider it into our articles of association. So that is why we have to file the restated article, so that the rights of the preference shares are being maintained. So generally people use the preference shares as it's very much versatile instrument. Next slide. This we already discussed in the very first slide, so it's repeat. Next. Yeah, so why preference is just because they have a right over equity, they have a right when the company goes into liquidation, they have a right in case of distribution of profit. There is a so because of all this, people prefer the preferential holders. So this is the comprehensive summary of the preferential. Because of that, the accounting aspect is different, taxation is different. So this is all about the preferentials. Thank you.
Thanks. Thank you, Akshay.
Yeah, welcome.
Yeah, now, Mr. Bala, we can take the question.
Yeah.
Nikita, stop sharing the screen.
Yeah, you said actually the specific cases on the taxation we will not answer here, because somebody has talked about the specific question, so we leave that question. Or premium on redemption, the preference share, interest or capital gains. I think this we discussed actually. If the company is not redeeming as per the terms, I believe, first of all, the company and the management are at default. Can they only have to work out the remedies? Yeah, that also we talked about it. Can you elaborate the voting right as an equity shareholder? Is there any difference between the holding preference share where the dividend is not paid for the 2 years and the equity share? I think this also you explained. Actually, they get all the rights after the 2 years the dividend remains. They can vote for all resolutions. How do you overcome angel tax in such cases if shares are issued that higher than FME? I think Asher has explained that how much is the chargeable on the angel tax. It's either upon just now.
Just one thing here, I would like to add, if your company qualifies as a registered startup, there are some conditions which the government has laid down for you to kind of get registered as a startup recognized by DPIIT. You can actually get that registration done and also take a 56 registration under Income Tax Act. And once you have both the registrations, you can actually claim exemption under from the angel tax.
How the paid up capital is adjusted, those cases where the face value of the equity share is 10 and the face value of the CCP is also 10, and the company has to allot more than one equity shares of the conventional CCP due to anti-dilution rights. I think you explained this,
We
what are
covered
the
it,
precautions,
yes.
you have given the practical example.
You want to add anything, Mr. Rahul, or we can go to next?
No, I think if my response was clear, I think that was actually the response to this question. So just need to ensure that your CCPS par value is little more than your equity at the time of issuance.
What are the best way to offer share ESOP to non-employees like consultants, legal and practical way?
We cannot, ESOP while you are taking here. Yeah, next.
Whether valuation report is compulsorily for issue, conversion, redemption, time of preparation, that you talked about it. In fact, you touched upon in both the places, 2 valuation report is required. Somebody has already asked this question. Whether the company is issued a redeemable preferred share at face value and redeemed at face value.
What it is, question or answer, not understand.
Whether, I don't know, he is asking probably.
I think the question would be that can I redeem without a premium?
Yeah.
I think it's possible. There is no legal restriction or mandatory requirement to always redeem at premium. You can always issue and redeem at par. I don't see a legal restriction.
As per rule 2H, the conversion price of CCPS can be decided at the time of when the holder is convertible security become entitled to apply for the share. But how to decide the issue price? And so, do we take a valuation report to decide the issue price, or do we take the ECB at the face value only? I think this valuation aspect you discuss elaborately, I think so.
So it's a regarding future price. When the preference share get converted, that pricing, the question is there.
Yeah.
Whether when the holder of convertible security becomes entitled to apply for shares.
See, it's always better to, whenever a valuation comes into the picture, it's always better to back it up with a valuation report, because company can be subject to scrutiny or queries or questions at any point of time. So till the time there is a legal document from an independent professional who says that yes, the valuation was this and the transaction has happened at that particular price only, it makes governance much more easier to establish from a company's point of view. So it's always advisable to have a valuation report whenever there is a valuation transaction related to a valuation which happens.
And you mentioned that at the time of issue also and at the time of conversion also.
Correct.
Yeah.
What is the minimum period of which redeemable non-convertible preferred share can be issued? This I think we discussed actually. Non-convertible redeemable preferred share qualify for Tier 2 capital under master direction of the Reserve Bank of India, non-banking financial company, scale-based regulation direction 2023.
Minimum thing only is repeating.
RBI guidelines are silent on minimum tenor. Companies Act talks about maximum tenor 20 years. Yeah, again it is talked about the minimum. You said actually.
Entire thing is talking about that only. Third paragraph also.
Yeah. Suppose the company has more than one type of the preferred share, does it have to necessarily issue dividend to all type of the preferred share? Of course, you have to issue the dividend because the preferred share dividend is already committed, isn't it? If the profit is there, you have to declare in all type. You cannot discriminate, no?
It is basically preference shares, and preference
Yeah.
shares definition and the main characteristic preference of dividend.
You're right.
You
So
can
you have to
have a different kind with a different right attached to it. But it basic characteristic of preference on dividend and redemption at the liquidation remains. So it is to be done.
To issue CCP's required valuation since there is no issue of any underlying equity at any point of time.
Yes, valuation would be required.
Is the terms of the issue mentioned percentage as dividend?
0%.
Yeah, it is, you said actually.
No. If terms of issue mention 0% as dividend.
No,
No, zero.
I think we don't mention it as zero, but like a 0.001, it's as good as zero. But just to ensure that, I mean, obviously putting something as zero in a legal transaction is not advisable. So the way we kind of address it is we keep it as nominal as possible.
Yeah, that is what you actually said. How do you actually do it in practice? Do issue of the fully redeemable preferred share required valuation since there are no issue of the underlying equity that you answered already. Whether the redemption can be out of taking the fresh loan in terms of ICD.
Means the source of redemption can be from fresh
Intercorporate.
loan from ICD.
Yeah.
Our PPT very clearly mentioned that when the redemption to be done from where, it is not possible. Suchita mentioned the thing. If you are not, then you are to issue fresh.
Yeah, she has already outlined the sources of a redemption.
So not by borrowing. So basically that redemption can be from by borrowing.
Which forms is required to be filed for preferred share conversion?
I mean, if you ask me the forms, I would say it would be your MGT 14 because you would need a shareholder's approval or at least a class approval. That's it. And this may also require a amendment to your articles of association because you're converting a class and that class itself will not be in existence and followed by your PAS 3.
PAS 3.
Correct. Can you throw some light on how to interpret the explanation for the removal of the debts? It is declared that the issue of the further redeemable shares of the redemption of preferred share under this section shall not be deemed to be an increase or, as the case may be, a reduction of the share capital of the company. In such case, all be viewed from the accounting perspective.
So he wants accounting explanation. Because this, our law is very clear that redemption is not reduction. Akshar, anything you want to add? I don't know. Accounting perspective.
No, as you said, rightly said, redemption is not a reduction of share capital.
And
It's
further,
just because when we issue the preferential which are redeemable, we don't show it as a share capital only. It is a classified under the liability side.
Yeah,
It is a reduction of liability. Yeah.
In case of the right issue of the preference share, is there a requirement of the valuation report if the shares are issued to resident or non-resident?
but what
Valuation report is required anytime, whether it is issued to resident, non-resident, or anyone.
But what I learned is the preference share will dilute the voting rights and control.
we discuss this?
That we discuss
All
elaborately.
structuring.
Up to what time period we can redeem preference share after completion of the tenure?
You have to do it
You
before
need to do it
before
before
tenure.
tenure. You cannot wait.
Yeah, next.
As per the presentation, right issue can be made only to the existing preference shareholder. Can we not issue preference shareholders on right basis to equity shareholders?
I think you can do that. I think what the presentation said that you can issue preference shares on a rights basis. So preference shares can be issued to your existing equity
Existing members. That is what the presentation said. It doesn't say only preference or equity. It says only existing members. Convertible preference share are treated as a equity and RPS is treated as liability. What about the optionally convertible and does RPS required valuation every year?
Akshar?
Yeah, so optionally convertible will be treated as a liability only till the time they exercise the option. When they will exercise the option, that time the accounting treatment will differ. So till that time, it will be considered as a liability.
And value.
And the fair value will depend on the accounting standard the company is following. There is no fair value doesn't require any, like it has to CCPS or this kind of shares. So it is required for all kind of instrument the company is having on their balance sheet.
Okay, thank you.
In case of the startups, what would be the key consideration in issuing the share to the founders, as many startups are dependent on funding by VCs for scaling up operations and also for good valuation for ultimate sale later?
I think the key here is, I mean, just to kind of answer the question from a different point of view, as a founder, you would want to ensure that your holding is as less diluted as possible. So ensure that getting shares right at the start of the company when the valuation is less, and as in when you will keep on getting new investors and the company grows, the valuation will keep increasing. So try getting the shares at the earliest as possible if you are not a initial founder or coming as a co-founder at a later stage. And also just be very what I say, possessive about your holding. I mean, try to give out to investors as less as possible in terms of holding on the cap table.
What can be done with the valuation certificate at the time of shareholder approval and the allotment is done at later date, which is not within the set timeline, 90 days, any solution?
One of the ways we deal with it is if you don't see a change in the valuation price of the company, you can ask for an addendum to the last valuation report. It can save a lot of money from the company also and still complies with the regulation of getting a certification.
Redeemable non-convertible preference share issued for 13 months. Redeemed normally at the end of the 13th month along with the dividend due. Somebody has put a question. Will it consider be a buyback under section 115 QA?
I think it's a tax section 115 QA for buyback.
Yeah, Akshay.
Just
Redeemable non-convertible preference share issued for a period of 13 months.
Hmm.
Redeemed normally at the end of the 13th month along with the dividend due. Will it be considered as a buyback under section 115 QA?
No, it is not a buyback. It's as per the term. We are repaying the loan, and dividend will only be taxed.
Yeah, here when you talk about the preference share, then itself is, as you rightly said, it is a non-convertible, he says. So which means it's a long-term borrowing. So your
Yeah.
borrowed money, you are refunded back. Where is the question of, buyback, etc.? That is right.
Yeah.
What is the DCF method? Discounted cash flow method, that is well elaborately discussed. There is nothing to talk about it. Is the redemption of the share called as a buyback of share leads to the additional tax burden in the company by way of the buyback? No, buyback is not
Akshay
involved at all.
already clarified, yeah. Next.
Whether preference can be transferred to any person like equity share.
Yes, why not?
Yes, it can be
Yes, you
transferred.
can. Transferability is allowed. DDT, I believe, is already been abolished in 2021. DDT is not abolished. DDT is actually switch on from hand to hand. Sometimes it is company pays, sometimes it is investor pays. That's all.
Akshay,
Tax is always there, isn't
Yeah,
it?
it's not abolished. It's a change. The structure
It
has
is only
changed.
change. Who pays the tax?
Yeah.
That's all. Because the regulator has been playing on that over the years. Whether the interest paid on the preference share liable to dividend distribution tax. No, where is the question of interest paid on preference share? It's a dividend, no, always.
Akshay, and then we have discussed taxation liability on dividend, right?
Yeah. He elaborately dealt on that. Company issued a redeemable preference share and the due date company is not able to redeem due to losses. Can we write off? Will it be permitted under the Companies Act 2013? Will it be treated other income and company liable to pay 30% tax as deemed income under section 56 of IT Act?
Actually, the process we have mentioned, if you can't do it, I think, and then you can, yeah, right? Because what he's telling, not able to, due to losses, can we write off? Akshay, Akshay, you got the question? Shall I read it out?
Yeah, I got the question. So when we write off any liability and the courts gives the order for writing off, that time, it is not treated as income. But when we write off with the permission of shareholder and all, when we write off the liability, it goes to a P&L and becomes the income of the company.
But the question is, we cannot write off only in this case.
Can we write
Aspect.
off, first of all?
No,
When you
write
say
off is we are not.
redeemable preference
So
share,
that only I was telling
can
Suchita.
you write off? Because I think Suchitra puts up the plan. If you are not able to redeem, what are the various revenues available to
Yeah.
the preference shareholders?
We have explained the procedure where
You
the
have
company
explained
is,
what are the
yeah,
revenues
it's
which
not
are
in a
available.
position, yeah,
It
to
cannot be
redeem.
written off just like that.
It can issue further redeemable preference shares with the
Yeah.
approval of NCLT and the preference shareholders, as we explained in this presentation.
Correct. Is there any limit on issue of the preference share compared with the paid up share equity share capital?
Obviously, it cannot cross the paid up.
Okay. Can PPT said, I already said in the past also, I have been saying, now also it is saying the webinar has to actually get recorded. The recorded webinars will be disseminated through the YouTube, which will be available. PPT as such is not shared. Please note. Company issued a redeemable preference share of 2 preference shareholders who are companies. Now those 2 companies status in ROC is strike off. Can a company write off the preference share as 2 preference shareholder not existing? Is it permitted?
Writing off is not permitted. It's a specific case. We have to deal with separately. Mr. Rahul, you want to add anything?
No, I think it's also a unique situation. So,
It's
I mean,
required lot
straightforward
of,
write-off is not
So
possible.
without legal procedure, we cannot write off this.
yeah, so it
Yeah.
requires a lot of facts and materials to answer these questions.
Whether the share can be issued at the price less than the valuation report price.
See, so the first of all, if it's you are issuing to a non-resident, it's not possible. In case it's a shares are issued to a resident, if you are going under the private placement, then also it's not possible because the law very clearly says that the price has to be determined by a valuation report. The only open point or the gray area is if you do a rights issue. So can you do it at a price lesser than the valuation report price? So again, there is no clear-cut rules when it comes to the rights issue. It's up to your interpretation. If I mean, you can do it. I mean, there is no legal restriction as such. But again, it's up to the professionals' kind of interpretation and opinion how they would kind of treat this if it's a rights issue process.
If the company has RPS and covered under Ind AS, in such a case, whether valuation report is required for reporting RPS at the end of the year as liability.
So company's auditor will individually do the valuation. They will consider some companies do take the valuation report from the valuer, and some gives to their CA as assignment to get the value. So it is not mandatory to take it from some registered valuer or a merchant banker.
If a company issues a preference share on a right basis, and the existing shareholder is not participating in the same, in that case, whether the company issue the unallocated preference share to the person other than the existing shareholders.
Yes, you can do it.
I think that is all. That is the end of the questions we have come to. There is no more questions. I finished off.
Now we can allow.
There are a couple of hands have risen, which I can see here. So we can ask them. I think probably there should be given a facility to unmute the mic.
Yeah.
Yeah, Bala, I have raised. Can I say something?
Yes,
Yeah.
yes, sure. Yes, Nikhil, you
Yeah,
are
in one
always
of
welcome.
Yeah, thanks. No,
It
in
is
one of
nice
the
to have you on
questions,
this. Yeah,
no, I was there right from the beginning.
I
See,
know.
in one of
I
the
know.
questions,
You are always, your value addition is very much appreciated, Nikhil.
Thanks. See, one of the questions somebody asked that if the company preferences held by 2 companies and if they are liquidated. See, normally liquidation, what happens? Either there is a liquidator is appointed or it is a self-liquidation. So in that case, he holds these shares. Now, assuming that they will try to sell these shares, preference shares held by the company in, let's say, another ABC private limited or limited, which has issued the shares, and they will sell it in the market. That could be the possibility. Now, assuming that for some reasons gets liquidated without realizing the assets, then there is another law which says that unclaimed preference shares as well as like fixed deposits, this will go to IEPF. So there is no question of write back from the point of view of the issuer. That's all I wanted to add.
Okay, thank you.
If
Yeah.
anybody wants to add anything else.
No, it's a complicated, Nikhil, so I intentionally not answered because there are many things in to be considered, Nikhil. Because striking
True.
of.
I mean, so simply write back is not the.
Write back-
Right back is
Yeah.
definitely, Nikhil, as you rightly say, right back is definitely not possible. That is
That
very,
is
very
not-
I mean,
clear.
that was the question. That was the question
Yeah, so
asked by
that's
somebody.
why, it is not allowed.
That's
that-
why I said
Yeah.
it will go to IEPF. You can write back.
Yeah, thanks a lot, Nikhil.
Thanks.
Jay
Yeah,
Gopal,
Mr. Sumit,
any one of you, Jay Gopal, Mehul, Sumit, any one of you can unmute and talk.
Mr. Sumit, you can unmute and speak.
I think Aniket Shah is talking. Aniket,
Yeah,
can we hear Aniket?
let's move to Mr. Mehul. Mr. Mehul Bakshi. I think they got the answer or what? Because they must have put in chat box.
I don't know. Jay Gopal, Sumit, Sandeep, anyone can unmute and talk.
I think everyone is hungry and.
Yeah.
Vicky, I'll just
Mr.
add one more
Sandeep,
thing.
Yeah, Nikhil.
Yes, Nikhil.
Like in the case of preference shares, if the dividend is not declared for consecutive 2 years, it can give rise to various scenarios. Now, if the holders are, let's say, a private limited company, now as you know that holder will have a right to vote on all the resolutions. So it is at par with the equity shareholders. Now, let's have a simple example. Let's say equity capital is 5 lakhs, and let's say that they have issued 10 lakhs preference capital, and assume that it is held by only one private limited company. And since the dividend is not declared, suddenly they acquire 66% voting right. Now, this will have another scenario under the Companies Act that becomes the holding company. So, liable to compulsorily do the consolidation till the dividend is paid, and then it is out of the subsidiaries. So, these are some of the different scenarios which can come up.
Yeah, interesting. Yeah,
Interesting, Nikhil. Very interesting.
thanks.
Yeah, Sumit, are you there? Sandeep, are you there? Can we hear
Yes,
from you?
Yes.
Yeah,
Sandeep.
Just I want to know that in case of many companies, we have found that the many companies are is redeeming the shares, preferential share on basis of taking the ICDs. How they are doing this type of work? Whether you are saying that it is not possible at your end. They are
Sorry?
taking the fresh loan in the form of the ICD and redeeming it in the existing preferential shares.
It is
What is
not
the legal
allowed
format?
by law. It's very clear now. How they do, I cannot say. We cannot say honestly.
It means
Sandeep,
that it is very
Law
much
is very
wrong.
clear.
It is
Yeah.
in the contravention of the Companies Act rules.
Sandeep, as I said earlier also, so long as they did not get caught, they are free. The
Because law
moment
is very
regulator
clear.
comes, it's definitely a violation.
Yeah, he's asking because is there any way out or any exemption or interpretation issue?
Actually,
or
they
what?
have not issued any further preferential share to redeem the existing share preferential shares. They instead of further issue taken the fresh loan in the form of the ICDs in many companies.
But it is not allowed. It's under law, but they must have got some advice, but it's not.
Yeah,
And
unless we know the full detail, we may not be able to answer, but per se, by looking at
Yeah.
it, it is not. Yeah.
okay. And these preferential shares can be transferred to any person like an equity share in the open market.
See, again, the kind of company accordingly, no?
Like a private limited company who issues the shares, like preferential shares, can be
Yeah,
transferred to any persons.
Your article will be clear and mentioning many things. Accordingly, we have to case to case.
If
If
article
it is a
mentions
private-
it, then it is possible.
Yeah,
Preferential
like
shares are
preference shares are-
transferable.
Yeah, preference share are transferable. For example, if it is a
Transferable,
private
like
limited
equity.
company,
With
it
the
will be
permission of the company or
subject
without
to
the permission of the
approval
company.
Board of directors.
See, that's why I say that.
No, if it is
For your private
company,
equity share, what you will control.
It is
same
a
thing.
private limited company. In that
Exactly,
private limited company,
I got it. So if for equity shares, you will go back and check article. Similarly, for preference shares, you have to check that at least that whether I can, because it will be gone by that basic
if
principle.
my
Transfer,
article permits to me, then it can
transfer
be
is
transferred in
possible.
the open market to any other company.
See, it
If I
can be
have issued
cannot be
it to the
open market. What it can happen is, I mean, a buyer can be identified, but ultimately it has to come to the board for an approval
Yeah,
because it's
the
a
board
private
will
company.
finally approve. Though the
board
transfer is
will finally
possible even for the preference shares.
it can be transferred on the with the approval of the board. I cannot
It is a
sell the share.
normal share transfer procedure what we follow for the equity in a private company.
So your question is that AB is shareholder, whether the said share can be transferred to X, which is
Yes, yes.
not known to them. X should
Yeah.
be identified and the same should be approved by the board and the transfer will be done. That
If
is
the board does not approve that, it is any legal remedial with me.
See, now we are entering too much because as article I say that again, it is the reason for any action, board has to give reason. And it is a subjective matter with the decided cases. That's why I will not go ahead in this answering. Because then board has to give reason also. Okay?
See, when you are talking about the private company has got so many restrictions. What can be done, what cannot be done, etc. and other thing. And within that line, as Dipti puts it very clearly, the valid reason is the things is rejected, you cannot actually transfer. But per se, preference share can be transferred, but is subject to the approval of the board of directors.
So if I get a good price from the market, but the board is not, and the board is redeeming it at the
Mr.
price which they have
Sandeep,
offered to me.
Mr. Sandeep, I answered
Sandeep, price is not the only consideration. There are other considerations are there because that is why the restrictive clauses are there.
Yeah.
We have to go by that, isn't
Yeah.
it? Without knowing the thing, generally we cannot answer. That is the thing. That's what Dipti is also saying.
Thanks, Mr. Sandeep. Yeah.
Actually, I'll tell you, this is actually, if you go to private market, getting
However,
liquidity is mostly on paper. That's how we see it. So getting liquidity is also very difficult when it comes to the private market. Unlike like a public market where like shares are open to like freely transferable.
Now, thank you.
Rahulji, however, that currently, Dipti, 1 minute.
Yeah,
However, currently, if it is a public company, as you know, that all the securities has to be in demat form. So in that case, there may not be condition as far as securities are issued by the public company. So in that case, if you have some privately, you have got some buyer, it should be freely transferable. But if it is a private limited company, though there is a demat compulsory, but approval of board, I think is necessary. So the
Yeah.
transferability could
See,
still be a
in
little
demat,
restricted.
yeah, in demat, there is a concept of freezing of ISINs. So I think ISIN gets auto freeze when it's generated for a private company and only by a request that lock-in is released. So there are other ways of checks and controls which a private company can put. Even in the articles, you can put a mandatory clause where you can say that even for demat shares, a board approval is required. So there are like other ways in which control can be established for a private company, but if it's a public company, then to a lot extent, you have the liberty under the law to kind of openly get into secondary transactions.
Absolutely. If you have sought or you have identified the buyer and he is willing to buy, then that can be done.
I think we answered all questions. All the people who raised their hand has spoken, and we can close our webinar. Right? Thanks. Thanks a lot, everyone. Thank you,
Thanks
Mr.
everyone.
Rahul. You
Thank
are most suited today because the kind of question another Rahul is asking, you could only answer that.
Glad to be on for the session.
Rahul, I must sincerely express my thanks to you because really speaking of the preference share, when we thought, oh, it's a very small presentation, what is going to be there? So much intricacies and so much interaction. It is actually shown a lot of things you are sharing was very, very valuable. Nikhil has brought out that issue, especially, the last question when he is saying the right of issue, etc. transferring to the IPFF, etc. It's all really, really value addition to us. There's a lot of learning which is coming out from this session. It's very excellent. Suchita, you have excellently covered everything and you opened the floor to the various questions. That is what you have done. Excellent job.
Thank you.
Thanks a lot.
Akshay, thank you.
Thank you very
Akshay,
much to all of you.
Yeah.
Yes, Dipti, your last word.
Yeah, Akshay, thanks for your all inputs. Thanks a lot.
Welcome, madam.
Have
I
a
would
good-
like to thank Rahul sir for his valuable insights on the topic. It was really very
Always a
helpful.
pleasure.
Yeah, practically we got to know many things which we can practice in our this thing also daily.
Rahul, really, you walk the talk. You said sharing the knowledge, not just knowing the knowledge. You did that today. Thanks a lot. Thank you so much.
No, welcome. It's a
Thank
welcome.
you.
sir.
Thank
Yes.
you.
Thank you so much.
Thank
Have
you.
a good
Thank you,
weekend.
Yes.
Yet
Wish-
we
wish
meet next
everyone the
week in
same.
some other topic.
Yeah.
Thank
Thanks
you.
to the
Thanks,
participants.
everyone.
Bye.
Thanks.